After studying this module, you shall be able to know the process of developing an IFRS, get to know all the standards and interpretations issued by IFRS, learn what the difference between adaptation, adoption and convergence, know about the implementation schedule of Indian Accounting Standard, know the details of some standards issued by IFRS Foundation. In this module, we shall study about International Financial Reporting. International Financial Reporting Standards (IFRS) are developed through an international consultation process, the due process, which involves interested individuals and organizations from around the world. The due process comprises 6 stages, with the trustees of the IFRS Foundation having the opportunity to ensure compliance at various points throughout. First, setting the agenda. The IASB evaluates the merits of adding a potential item to its agenda by evaluating the following. First, considers the relevance to users of the information and the reliability of information that could be provided if a new standard is developed. Second, the possibility of increasing convergence because of the development of the new standards. Third, resource constraints, if any, in the development process. Second, planning the project. After adding the agenda, IASB make an execution plan where it is being decided that whether the project would be done alone by IASB itself or with the collaboration with someone. Third, developing and publishing the discussion paper, including public consultation. Although a discussion paper is not mandatory, the IASB normally publishes it as its first publication on any major new topic to explain the issue and solicit early comment from constituents. If the IASB decides to omit this step, it will state why. Typically, a discussion paper includes A. A comprehensive overview of the issue, B. Possible approaches in addressing the issue, C. The preliminary views of its authors or the IASB, and an invitation to comment, developing and publishing the exposure draft, including public consultation. Publication of an exposure draft is a mandatory step in due process. Irrespective of whether the IASB has published a discussion paper, an exposure draft is the IASB's main vehicle for consulting the public. Unlike a discussion paper, an exposure draft sets out a specific proposal in the form of a proposed standard or amendment to an existing standard. The development of an exposure draft begins with the IASB considering first, issues on the basis of staff research and recommendations. Second, comments received on any discussion paper. And third, suggestions made by the IFRS Advisory Council, consultative groups and accounting standard setters, and arising from public education sessions. After resolving issues at its meeting, the IASB instructs the staff to draft the exposure draft. When the draft has been completed and the IASB has balloted on it, the IASB publishes it for public comment. Next, developing and publishing the standard. The development of an IFRS is carried out during IASB meetings when the IASB considers the comments received on the exposure draft. After resolving issues arising from the exposure draft, the IASB considers whether it should expose its revised proposals for public comment, for example, by publishing a second exposure draft. In considering the need for re-exposure, the IASB identifies substantial issues that emerged during the comment period on the exposure draft that it had not previously considered, assesses the evidence that it has considered, evaluates whether it has sufficiently understood the issues and actively sought the views of constituents, and considers whether the various viewpoints were aired in the exposure draft and adequately discussed and reviewed in the basis for conclusions. Next, drafting the IFRS. The IASB's decision on whether to publish its revised proposals for another round of comments is made in an IASB meeting. If the IASB decides that re-exposure is necessary, the due process to be followed is the same as for the first exposure draft. When the IASB is satisfied that it has reached a conclusion on the issues arising from the exposure draft, it instructs the staff to draft the IFRS. Finally, after the due process is completed, all outstanding issues are resolved and the IASB members have balloted in favor of publication, the IFRS is issued. Sixth, procedures after an IFRS are issued. After an IFRS is issued, the staff and the IASB members hold regular meetings with interested parties, including other standard setting bodies, to help understand unanticipated issues related to the practical implementation and potential impact of its proposals. With the reorganization of International Accounting Standard Committee IASC to IFRS Foundation, there has been a change in various nomenclatures that are used. All the standards and interpretation that IASB has issued till 2001 were known as International Accounting Standards IAS and SIC respectively, whereas now all these standards and interpretations that are issued by the new body are known as International Financial Reporting Standards IFRS and IFRIC respectively. Let us now discuss some list of standards and interpretations. Here is the list of all standards and interpretations issued by IFRS Foundation and its predecessor IASB. International Financial Reporting Standards IFRS. IFRS 1. First time adoption of International Financial Reporting Standards. IFRS 2. Share-based payment. IFRS 3. Business combinations. IFRS 4. Insurance contracts. IFRS 5. Non-current assets held for sale and discontinued operations. IFRS 6. Exploration for and evaluation of mineral assets. IFRS 7. Financial instruments disclosures. IFRS 8. Operating segments. IFRS 9. Financial instruments. International Accounting Standards IAS. IAS 1. Presentation of financial statements. IAS 2. Inventories. IAS 7. Statement of cash flows. IAS 8. Accounting policies, changes in accounting estimates and errors. IAS 10. Events after the reporting period. IAS 11. Construction contracts. IAS 12. Income taxes. IAS 16. Property, plant and equipment. IAS 17. Leases. IAS 18. Revenue. IAS 19. Employee benefits. IAS 20. Accounting for government grants and disclosure of government assistance. IAS 21. The effects of changes in foreign exchange rates. IAS 23. Borrowing cost. IAS 24. Related party disclosures. IAS 26. Accounting and reporting for retirement benefit plans. IAS 27. Consolidated and separate financial statements. IAS 28. Investments in associates. IAS 29. Financial reporting in hyperinflationary economies. IAS 31. Interest in joint ventures. IAS 32. Financial instruments presentation. IAS 33. Earnings per share. IAS 34. Interim financial reporting. IAS 36. Impairment of asset. IAS 37 Provisions, Contingent Liabilities and Contingent Assets. IAS 38 Intangible Assets. IAS 39 Financial Instruments, Recognition and Measurement. IAS 40 Investment Property. IAS 41 Agriculture. Note, IAS 3, 4, 5, 6, 9, 13, 14, 15, 22, 25, 30, 35 have been superseded. Next, IFRIC. IFRIC 1 changes in existing, decommissioning, restoration and similar liabilities. IFRIC 2 members, shares in cooperative entities and similar instruments. IFRIC 4 determining whether an arrangement contains a lease. IFRIC 5 rights to interest arising from decommission, restoration and environmental rehabilitation funds. IFRIC 6 liabilities arising from participating in a specific market, waste electrical and electronic equipment. IFRIC 7 applying the restatement approach under IAS 29 financial reporting in hyperinflationary economies. IFRIC 10 interim financial reporting and impairment. IFRIC 12 service concession arrangements. IFRIC 13 customer loyalty programmers. IFRIC 14 the limit on a defined benefit asset, minimum funding requirements and their interaction. IFRIC 15 agreements for the construction of real estate. IFRIC 16 hedges of a net investment in a foreign operation. IFRIC 17 distributions of non-cash assets to owners. IFRIC 18 transfers of assets from customers. IFRIC 19 extinguishing financial liabilities with equity instruments. Note, IFRIC 3, 8, 9 and 11 have since been withdrawn. SIC. SIC 7 introduction of the euro. SIC 10 government assistance, no specific relation to operating activities. SIC 12 consolidation, special purpose entities. SIC 13 jointly controlled entities, non-monetary contributions by ventures. SIC 15 operating leases, incentives. SIC 25 income taxes, changes in the tax status of an enterprise or its shareholders. SIC 27 evaluating the substance of transactions in the legal form of a lease. SIC 29 service concession arrangements disclosures. SIC 31 revenue barter transactions involving advertising services. SIC 32 intangible assets website cost. Note, SIC 1, 2, 3, 4, 5, 6, 8, 9, 11, 12, 13, 14, 16, 17, 18, 19, 20, 21, 22, 23, 24, 26, 28, 30, 33 have been superseded. Let us now understand convergence, adoption and adaptation. The above listed standards and interpretation gives the world a concrete set of practices which should be followed in order to have globally comparable financial statements. Now, the question is how various countries will follow these standards and interpretation, as we can appreciate that such a shift cannot happen overnight. It will definitely take time, but how much nobody knows. All the countries want to follow such a system which will place them in advantageous position and make them more attractive destination for foreign capital. But starting to follow a system of uniform standards is a very complex process. As we already know that many countries came out with deadlines for following IFRS, but could not meet them and the process was delayed. In the case of India, we had an implementation date of 1st April 2011, but it was not materialized and delayed. For other countries, also implementation has been delayed. What countries need to do for implementation of IFRS? The first step would be the need to converge their accounting standards to IFRS. Convergence refers to the process of establishing a single set of accounting standards that will be used internationally. So, any step taken by a country to make its accounting standard similar to IFRS would be known as convergence. A country can directly adopt the standards and interpretations issued by IFRS Foundation. Adoption process is not that simple as it sounds, and every country can't right away adopt the standards as business environments differ widely from one country to the next. And so, there is no guarantee that the IFRS are the best for all countries. Then, what are countries doing to implement IFRS? They are adapting it rather than a plain adoption. Standards given by IFRS Foundation are being modified to meet the specific differences in the business environment. This is what many countries including India have done. IFRS are known as principle-based standards that do not prescribe detailed rules, leaving the task of actual accounting processing to the discretion of individual companies and auditors. Transactions of similar nature may therefore be processed quite differently according to how they are interpreted by each company. This can easily give rise to window dressing. So, adaptation makes more sense than adoption as it will limit the discretion of the preparer of the accounts. On the other hand, it may also lead to the defeat of the whole purpose of convergence, as in the process of adaptation, countries will give out different methods of preparing financial statements and it will not be different from the existing system. Moving on to Indian AS implementation schedule. The MCA, through its notification dated 16 February 2015, has issued the company's Indian Accounting Standard Rules 2015 rules, which lay down a roadmap for companies other than insurance companies, banking companies and non-banking finance companies (NBFC) for implementation of Indian AS converged with IFRS. A. Implementation will take place in two phases. Under phase 1, all the listed and unlisted companies whose net worth is equal or more than Rs 500 crores are included. Companies under phase 1 would have to mandatory implement Indian AS from 1st April 2016. B. Companies under phase 2 have to mandatorily implement Indian AS from 1st April 2017. It includes all the listed companies and as well as the companies that are in the process of getting listed. In addition to listed companies, unlisted companies with net worth equal or more than Rs 250 crores are also included. Although companies can implement Indian accounting standard voluntarily from 1st April 2015. This notification is also applicable to group companies, holding subsidiaries, joint ventures or associates of companies covered in A and B above. This may also impact fellow subsidiary companies while preparing CFS of the holding company. Let us discuss the sum standards in detail. Now, we will explain some of the important accounting standards issued by IFRS Foundation or its predecessor IASC. One of the accounting standard, which is IAS 21, the effect of changes in foreign exchange rate. This is an important accounting standard as in the world of globalization, companies are doing business in more than one country, which leads to the problem of foreign currency translation into the currency of home country. As we all know, foreign exchange rates are continuously changing as they are determined on real-time basis. Transaction becomes very complex and comparison of financial statement becomes impossible. Now, with the help of an uniform standard for these situations, things would be better once there is global implementation. In particular, IAS 21 gives the methods of this conversion and reduces ambiguity. An entity may carry on foreign activities in two ways. It may have transactions in foreign currencies or it may have foreign operations. The objective of this standard is to prescribe how to include foreign currency transactions and foreign operations in the financial statements of an entity and how to translate financial statements into a presentation currency. The principal issues are which exchange rates to follow and how to report the effect of changes in exchange rate in the financial statements. This standard does not apply to hedge accounting for foreign currency items, including the hedging of a net investment in a foreign operation. A foreign currency transaction shall be recorded on initial recognition in the functional currency by applying to the foreign currency amount the spot exchange rate between the functional currency and the foreign currency at the date of the transaction. At the end of each reporting period, A. Foreign currency monetary items shall be translated using the closing rate. B. Non-monetary items that are measured in terms of historical cost in a foreign currency shall be translated using the exchange rate at the date of the transaction. And C. Non-monetary items that are measured at fair value in a foreign currency shall be translated using the exchange rates at the date when the fair value was measured. Exchange differences arising on the settlement of monetary items or on translating monetary items at rates different from those at which they were translated on initial recognition during the period or in previous financial statements shall be recognized in profit or loss in the period in which they arise. Another important accounting standard which gives principle for inflation accounting IAS 29, financial reporting in hyperinflationary economies. This standard shall be applied to the financial statements including the consolidated financial statements of any entity whose functional currency is the currency of a hyperinflationary economy. This standard does not establish an absolute rate at which hyperinflation is deemed to arise. It is a matter of judgment when restatement of financial statements in accordance with this standard becomes necessary. Hyperinflation is indicated by characteristics of the economic environment of a country which include but are not limited to the following. A. The general population prefers to keep its wealth in non-monetary assets or in a relatively stable foreign currency. Amounts of local currency held are immediately invested to maintain purchasing power. B. The general population regards monetary amounts not in terms of the total currency but in terms of a relatively stable foreign currency. Prices may be quoted in that currency. C. Sales and purchases on credit take place at prices that compensate for the expected loss of purchasing power during the credit period even if the period is short. D. Interest rate, wages and prices are linked to a price index. And E. The cumulative inflation rate over 3 years is approaching or exceeds 100%. The financial statements of an entity whose functional currency is a currency of a hyperinflationary economy shall be stated in terms of the measuring unit current at the end of the reporting period. The restatement of financial statements in accordance with this standard requires the use of a general price index that reflects changes in general purchasing power. It is preferable that all entities that report in the currency of the same economy use the same index. When an economy ceases to be hyperinflationary and an entity discontinues the preparation and presentation of financial statements prepared in accordance with this standard, it shall treat the amounts expressed in the measuring unit current at the end of the previous reporting period as the basis for the carrying amounts in its subsequent financial statements. Let us now recapitulate what we have learned so far. In this module, we have learned about the due process which is followed for development of standards. We have also learned the difference between adoption, adaptation and convergence. Adoption of IFRS is implementing it without making any changes, but adaptation is implementing according to the needs of the country. A few standards have been explained in detail and how they add to the field of accounting. Thank you.